we look at the broad picture, we think that our view is of economic growth recovering, of the world opening up over the next 12 months is still the right one. And we're seeing that in growth figures coming out of the US, out of the UK, but we still have situations where you have to show some caution, where there's new variants that come out, and that's probably the risks that we're really focusing on over the next 6 to 12 months from an investment point of view. In Australia, we are, I think, looking through this disruption at the moment in terms of the businesses that we own. We've seen from the last outbreak a year ago that once we get through it, businesses bounce back very quickly, earnings recover, and we've seen that from the Australian banks, we've seen that from the healthcare companies. So we're not making major adjustments to our portfolio as a result of this, these short-term lockdowns in Australia. Another factor I'd like to just point out is the reduction in bond yields, which has been really interesting. We've seen the US 10-year fall right back to 1.2%. And we're seeing definitely inflation picking up around the world, and it's intriguing that we're seeing rising inflation but lower bond yields. So it's not entirely consistent. What we see is the market, particularly in the US, is looking through this inflation right now and saying, hey, in 6 to 12 months that inflation won't be there. Some of these pressures around transport, lumber and different price pressures won't be there. Interestingly, we have seen the lumber price halve in the last 3 months. So there are arguments both ways. And New Zealand's slightly different in that we at the moment have strong growth, but very tight labour market, unemployment rate of 4%. So we're watching that very carefully in the companies we own to make sure that they can manage to put up prices if they're seeing inflationary pressures. But we have a broad range of portfolio holdings, and we feel pretty confident that they will be able to manage a period of higher inflation if it does occur. Today I thought it would be useful just to talk about 3 portfolio holdings that we're excited about at the moment. They are Resmed, Ramsey Healthcare and Virgin Money, which is a UK bank listed in Australia. Why I'd like to talk about these businesses is we have healthcare. Resmed and Ramsey are both healthcare businesses but in different parts of the healthcare market. Virgin Money is a recovery name which is linked to the UK recovery, UK economic recovery. Firstly, I'll mention Resmed. This is a unique investment opportunity that we've enjoyed strong performance from since we've been invested. Resmed is benefiting from a number of long-term drivers. It is a producer of sleep apnea devices and associated masks. Sleep apnea is a condition where you have a very fitful sleep. You stop breathing briefly during your sleep, which can have medical consequences. As a result of the global population getting older and more obese, growth rates and demand for these products grows typically at about 8% per annum. In the last few months, one of Resmed's major competitors in the US, Respironics, owned by Philips, which is a major European company, announced a recall of their devices based on the foam around the device having health risk if it was ingested and potentially cancer risk. So as a result, they may be out of the market for up to a year and a half at the maximum, 12 months at the minimum, which means that Resmed could potentially take all of their market share and have a much longer growth, a period of elevated market share for a long period of time. So that's resulted in the market upgrading their earnings. Now we think the market's still underestimating the earnings growth, so you have A, the tailwind of that long run growth profile, but B, you have now a long run market share opportunity. So that's one that we're excited about. We have made very good returns for our investors in recent months. The second one is Ramsey Healthcare, which is a private hospital business, and we see that as a really good recovery stock into this recovering global economy. Private hospitals make money by simply procedures. They have either private insurers will pay for a procedure if you have private health insurance, or where public hospitals are very busy, they will push over patients into the private system. So during the pandemic, obviously Ramsey was under pressure, given that there were less procedures, but fortunately governments around the world recognised how important these private hospitals were, and they covered their costs so they'd be available to treat COVID patients. Now, as we know, in Australia, COVID patients didn't eventuate in any large number during the initial phase of the pandemic, but Ramsey came through that in very good financial health, and now they're positioned to respond to this huge backlog that's there at the moment. So in Australia, we have got a lockdown at the moment. They are actually still operating. The private hospitals in Ramsey are allowed to operate, but some of the public hospitals are closed. So they are benefiting. We don't know how much and whether there are offsets, but we're encouraged by that in the short term. In the medium term, there's a 1 to 2 year backlog in Australia for procedures. That will benefit Ramsey when the economy reopens. Secondly, they have a business in the UK. Now, listening to what I said in the UK, 90% first dose vaccinated, there is a 5 to 10 year backlog in the UK. So this business will benefit over a 5 to 10 year period with elective hospital procedures, NHS procedures coming across to Ramsey. So we're very positive on the recovery. We're looking through any weakness that may happen in the next few months, and we see a great tailwind for the next 2 to 3 years. The last business I'd like to talk about is Virgin Money. Now, it is a UK listed bank as well, but also Australian listed. Around 70% of the shareholders are Australian for this business. It came out of National Australia Bank originally through Clydesdale, and it merged with Virgin Money in the UK. Why we like this business is if you look at the UK, 90% of the population vaccinated, UK GDP growth growing at 7%, unemployment rate in the UK is 4.7%, and house prices, like New Zealand and Australia, are rising around 10% per annum. New Zealand and Australia have obviously seen much bigger increases, which is a cause for a little bit of concern, which I'll talk about another time. So in that sort of environment, we're seeing very low bad debts. We expect to see very few bad debts. They have a good margin environment, and they have a very strong cost out strategy. So when we look at the valuation, it's trading at very, very cheap multiples with some very strong earnings growth. So that's a business that we have a position in, we're excited about, along with some of our Australian bank holdings.